Hello and welcome to episode 324 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back to the show. How are you doing?
I'm very good. Yeah, very good. Very hot. I'm recording the podcast in a slightly different location this week, and I'm back at home and I'm in my loft and I've had to shut all the windows. And so if I start to hyperventilate or sound like a panting dog, you realise that it's probably because I am slowly dehydrating the longer I do the podcast. But apart from that, it's been fantastic. We had some really good reviews this week, didn't we, Andy? We did say to podcast listeners we would read a couple of them out, and we've had some really good and motivating reviews. So I think you're going to read one or two of them out.
Yeah, let's read a couple of those out right from the get-go. So the first one is from Twaddlebunk, which is possibly my favourite name that I've ever read out on the podcast. Damien and the gang bust the jargon, tackle nearly every topic in personal finance, explain the markets and give general recommendations week on week. I'm too old to benefit from a lot of the information given, but I've got my kids into it and they don't necessarily get all the nuances of some of the information, but it has brought financial matters to the dinner table and made it something we can discuss as a family, which can only be a good thing. I love that one. Okay, let's move on to another one. Let's do a quick two more. We'll do 3 this week, and hopefully that inspires some of you to get your reviews in and we could be reading you out next week. So the next one is from Steve RO458. I've subscribed to the Money to the Masses podcast for about a year now. I especially enjoy the midweek markets edition. That's great. That's one that I don't get involved in. That's a shame. Damien is concise, insightful, and demonstrates a real understanding of the current state of the markets. And finally, let's go with Amal. In April 2021, I started to listen to financial related podcasts, and Money to the Masses was recommended via different platforms. I love the structure of the podcast and the conversational nature of it. So thanks ever so much to those people that have taken the time to review the podcast. And don't forget, Damien's been pretty generous in the last few weeks talking about mug-worthy things that you could be doing as listeners. Well, I'll tell you what, here it is. If you do your review and you get that review read out on the podcast, we will be sending you out a coveted Money to the Masses mug. So if any of those 3 reviews we've just read out is your review, then get in touch with us and we'll send out a mug. If you could email Lauren at moneytothemasses.com, claim your review, and you'll have to supply us your name and address, and we'll get that out to you in the coming days.
Those were great reviews. I particularly like the one about the dinner table, because it is important that we do talk more about money openly. And going forward, hopefully we will be doing more for people of different generations. So that review mentioned about people who are younger. We are going to be doing some money tips on the Money to Masses platforms. So look out for that. It was something that was fed back. We did a whole piece of market research effectively. We sent something out to all our newsletter subscribers. So if you're not part of the Money to the Masses newsletter, then do go and subscribe. Just go onto the website, and we send out a newsletter every Sunday at 10 a.m. with a roundup of the Sunday newspaper's money sections and all the main stories that will impact your finances throughout the week, as well as content and videos from us. But we're going to be putting some deals in there because people wanted that. But we're also going to be doing more stuff on socials. TikTok is a thing that's going to happen. So hopefully we will be more down with the kids than we already are.
Okay, good stuff. So what have we got coming up on this week's show?
Right, there are 3 pieces on this week's show as usual. I want to talk about an insurance strategy. So a general theme about insurances. So one of the big things you should do with your life is insure against disaster. But there is a point where you need to stop doing that. So I want to talk about the idea of insurance and self-insuring when you do it. The other thing I want to talk about is the loyalty penalty crackdown that's coming in at the beginning of 2020. So basically there's a rule change that means that home and car insurers won't be able to charge existing customers more than new ones. But there's some nuances in it. But the reason I'm doing it, people will know that I don't tend to just do newsy pieces, but it's because there's something you all need to do before then. And finally, the last piece is a piece that kind of links back to that review, really, about families and generations. And I want to talk about a bit more philosophically about how wealth and money is very much like a party. And I'm going to explain what I mean by that, but help people to realise and view their own wealth and money in perhaps a slightly different light.
Right, so let's start with the insurance piece, talking about when you insure, when you don't, self-insurance, that kind of thing.
Yeah, so insurance is important, okay? So we're talking about all different types of insurance. So personal insurance like life insurance, income protection, we've covered these on the podcast, but most people will know insurances in terms of car insurance, home insurance. So when you are building any kind of financial plan or sorting out your money, insurance plays a key part of that. So you build your wealth, you maintain it, you grow it. But then one part of it is insuring against some form of disaster, whether that be that you become too ill to work, an accident, but it can be in the case of your home, say you get burgled or you have a fire. But there is a danger that we all start getting to the point where we can almost take on insurances too much, because insurance can be expensive. And there is a point whereby with most insurances that you need to review their use over time and whether you still need them. And what I've done is there's a matrix that I've produced by my own fair hands, which is going to be included in the post for this podcast. Every podcast show we do, if you go onto the Money to the Masses website, we have the latest show showing on the homepage, but we also have a link at the top of the page that says podcast, believe it or not, where you can go through and find a link to all the old shows. And in there, we put the resources that we talk about on the show. So it'd be links to articles, external links to other sites, or maybe in this case, an image that I want people to have a look at. And if you imagine, though, this is a very simple image, so you can visualize it in your head, listen to the podcast. So if you imagine there's a grid, an axis. So on the vertical axis, there is the severity of loss. So that's basically how much money you're going to potentially lose and the impact it's going to have on you. And then you're going along the x-axis, so that's the horizontal one, is the probability of the event. So you can see you can then split that axis into quadrants. So what you would have is the lower left quadrant, you'd have things that were low probability, so less likely to happen. So events. So they were events that would be classed as unlikely small losses. So an event that was unlikely to happen and the loss would be relatively small. If you move up along that x-axis, so things that are, again, the losses are likely to be small, but the probability of that event occurring are actually higher. Then if you've got the severity of loss axis, that's the vertical one, then the different quadrants you have is if the severity of loss is high, so you're basically likely to have a big financial impact on you, but the probability of that occurring is low, then you call that as something that's an unlikely severe loss. And if you move along, then the ones that are high probability and a large severity of loss, then they are the things where there's going to be a likely catastrophic loss occurring. So it's likely to happen. And if you look at the image or you visualize it, you can put different events, potential events, into different quadrants. And I want to give you some examples to show you how things could be positioned. But the thing you have to realize that the probabilities of events and the severity of any loss can change over time. So let me take an example of my cat, right, Bella, who's actually in this room at the moment with me, suffering with this heat. Bless her. She's fallen asleep under the table. So she's probably completely unconscious now from the heat, but I will let her out probably if she starts to moan. She's looking like she's moving. She's very old, right? So she's about 17. She was a stray that we took in. And we've had her insured for years, and she's actually, probably like most alley cats, seemingly manages to go through life without having too many issues. That's probably part of the reasons why she survived as a stray. Now, where we've had her renewal documents come through, she's got to an age now where the premium that they were going to charge me for insuring her for the next year was rocketing. We were going up into hundreds of pounds for a year just to insure her. Now, the issue is, with her age, as the policies start to change over time, or the ones that you can actually get for an elderly cat, what they cover you starts to diminish. And for example, with Bella, it started to get to the point that we were morphing more down towards the accident-only type of pet insurance that was really available for her. And we did have a policy that was pretty good that actually had a bit more than that. So there were limitations on what they would pay out, but they would do a bit more than pay out for a bit more than her just having an accident. They would also include some certain treatments if she was unwell. The problem is that the chances of Bella, bless her, I hope she's not listening too much, and I love her dearly, she hasn't got very long left, to be honest with you. And the next time she gets probably ill, it might well finish her off because she's 17 years old. And although she's been very hardy, this is just the realities of the world. The problem is, when I looked at that renewal document, the very easy thing for me to do was going, well, I don't want to have to pay out because I think she's very likely to become unwell. But when you look at, in reality, the average claim on pet insurance, it's just around about £1,000, perhaps towards 1,500. I can't remember the exact figure, but Lauren looked at all the numbers. She's the ninja, fifth Dan on pet insurance. If you want to know anything about pet insurance, if you listen to the episode that Lauren did, she knows everything. So we looked at the numbers and said, look, the likelihood is that they won't pay out for anything that's relating to her unfortunately being put down, and there'd be very limited payouts for other things, but the average claim claim for most pets is around about £1,000. Let's say, call it 1,200. But for me, I would have to pay, it was something like £200 to £300 to insure her. But I'd also have to pay a co-payment if I made a claim. So I'd have to put some more money towards that as well as the excess. When you started doing the numbers, if I made a claim, I could, if it was valid, obviously benefit. But the reality is that as times morph, then the usefulness of that insurance has started to diminish, because the probability of a claim, while it's gone up, the probability in that case also of the payout has started to fall. But the severity of loss has actually diminished. And that's because, bless her, the next time that obviously something happens to Bella, she probably won't make it much longer. So I'm not going to be paying out for years of chemo treatment or anything like that. So on that matrix, it meant that the severity of loss was low, but the probability, depending on how you viewed it, was probably low as well, and of the event happening where I would actually make a claim. So that meant that the best option for me, was to self-insure. Now, that's because I could afford to pay out that amount of money. If something happened to her, I would just pay for the treatment myself. I've got the money saved up aside on the premiums I've saved. But the other thing is that even if the amount is a little bit more than I could afford right now, I could start to budget for it. So that's the one where the probability is high that there'll be something happen. So that's the bottom right quadrant of the thing I described. Then I can start to budget for it. So what I've done is effectively save myself paying out for an insurance that is really not the value it once had. So that's the point of what I'm trying to talk about. So you put the events into the quadrants based upon the severity of the loss and the probability of that actually occurring. And then you can decide whether you should insure. Now, the point at which you insure is if the severity of the loss is very high, but the probability is not high. And that might seem a little bit on its head, but the reason that is because if the probability of the event occurring is very high, so I go and play in the traffic on the M25 every day, then the chances of me getting run over are very high. No one's going to probably insure me, or the cost of that insurance is going to be astronomical. I mean, it's a flippant example because that no one would actually insure you for doing that sort of thing. But the point is that you therefore would be better off just reducing the risk. Stop playing on the M25. So the point where you want to use insurance and it's good value is where the severity of the loss, me dying, is going to have a big material impact on my family, but the probability isn't heightened. So there's a fairly low probability in reality. And that goes for the same thing when it comes to income protection. So if you have an accident or you're too ill to work, the probability of it happening to you is relatively low in percentage wise, but the severity of that loss or the impact on you financially is enormous. So that's when it's good to insure against disaster. Now, I'll give you another example that I've come across recently where I've cancelled insurances. And that is in relation to some of the insurance policies you can have around the house, for example, on appliances. You get them these home care arrangements where you might have your boiler covered, your heating, your electricity, individual appliances in the kitchen. Now, I'm at the point in life where the appliances were once covered under a policy. So if it broke down, someone would come and fix them for you at no charge. But you're obviously paying a monthly amount. As time goes by, those insurances start to get more expensive because they start to charge you more because the things are more likely to break down. But the cost of the appliances, the balance of that versus that cost of insurance starts to skew out of kilter. So when I first had those appliances and fitted a kitchen out, and this is after guarantees have been taken into account, then it might make some sense to actually have these appliances because they didn't have warranties or anything on them because I couldn't afford to replace them and it was cost effective. As the years went by where I'd be able to therefore replace the washing machine or dishwasher in the short term, it doesn't make sense to keep insuring it because it gets to the point where the severity of loss is low for me because I can afford it. Won't have a financial impact on me if my washing machine packs up. For some people it does, and it did for me at one point, and therefore having insurance made sense because the impact financially on me, I couldn't afford it, but then the probability of it was at a level where it was realistic that might happen. The insurance, it wasn't too high probability that the insurance was ridiculous. The insurance was relatively cheap because the probability was low. That made sense. As the machines got older, the probability of a fault rose, the risks of a claim started to rise. It made the cost, obviously, of the insurance go up, but the severity of loss to me was lower. And so you get to a point, and I had to make a decision with my heating. I replaced my boiler. I always use that as an example in any of our money stuff, talking about boilers blowing up. I replaced my boiler early on in the year. And as a result, that meant that I had obviously the warranties and guarantees with the heating system, but I didn't need the insurances. I could review them. And so I started to go and look through some of these insurances. The one on appliances I got rid of because the financial loss of those things breaking was no longer there for me because it's moved over time. And so the message on this part of the podcast is to always review the insurances you have, place them on that quadrant, go and look at it in the notes of this podcast, assess the probability of an event likely to happen. If it's extremely likely probability, that could push the cost to a point where it's too expensive, so reduce the risks instead of trying to insure it. Where the probability is lower, which would make the cost more affordable, but the severity of the loss is high, then that's when you start insuring. In other instances, you then start to try and budget or self-insure. So that's why we talk about income protection, life insurance, home insurance, critical illness, all of these things. Of course, there are some insurances that are a legal requirement, things like car insurance. But what I want people to do is view the insurances they buy through that quadrant prism, as it were, that I've just given you, and you can find in the notes of this podcast.
I found that really interesting. It's insurance is my world anyway. It's what I've spent the last 15, 20 years working around, so I'm probably a little bit more clued up than most, but it's just a little reminder for me to not throw the baby out with the bathwater and just cancel these things. But it's an important and interesting piece that you've done there, and points that you've raised, and it actually highlights the importance of, by doing this, it also helps to highlight the areas where there are things missing and where you can plug the gaps. And remember, there are insurances in personal protection, for example, where you are guaranteed, where you can actually increase your policy irrespective of how bad your health is, if your health has deteriorated, based on certain life events like having children, getting married, changing jobs. So it's always worth considering what's happened in your life in the last, say, couple of years or however long it is since you last reviewed it, and then act on it accordingly. Okay, so moving on then, and still kind of on the insurance theme, Damien, you're going to discuss about this loyalty penalty crackdown that's happening and what it means for people.
Yeah, that's right. So from the 1st of January 2022, car and home insurers are going to be forced under new FCA rules to offer renewing customers the same price as new customers. Now, we've all been there, and we've had renewal quotes come through, and it's an annual annoyance for all of us where we get a renewal quote that comes through that is gone up again, and then you have to go on that merry-go-round and shop about. And one of the easy ways to cut the price is to go onto a comparison site, even find the insurance company that you are using, even if it's not the cheapest. You guarantee it'll be cheaper than the one you've got already, the quote they've given you as an existing and renewing customer, and then say to them, hold on, new customers get this, why am I not getting? And as long as the policies are like for like, there aren't any things that aren't included on the comparison sites. For example, it might be the excess might be different or anything. As long as you're comparing apples and apples, then they will 9 times out of 10 just honour that and then give you the cheaper price. So you haven't had to change insurers or do anything. You've just argued the point, and then you've got a reduction. I had to do it this year with my car insurance, which was extremely annoying to say the least, given that we've been in lockdown for basically a year. So the payouts they've had on car insurance will have plummeted. And so I had to have that merry-go-round. So what's happened is there was a super complaint by Citizens Advice back, I think it was in 2018, complaining about this phenomena where we are being overcharged just for being loyal. So that's where the loyalty penalty comes from. And by not shopping around, it was estimated it's costing people around about £4.2 billion over 10 years. I've seen bigger figures than that. It depends which piece of research. So what's happened with the FCA, they've come in and said, look, we're going to implement these measures and I'm going to explain them in a little bit more detail. And it should save consumers that £4.2 billion over 10 years. So it's a big number. But the way it's going to work is that the insurers have got to offer existing customers the same price as new customers, obviously assuming they are of the same risk profile. And of course, there are nuances within this. You sit and think, well, it depends how customers get to that insurance company. So, for example, they have different channels. So you could come via a comparison site and you might get a different price than somebody who went directly to the insurer or who came through a different channel. The way this is meant to work is that they've got to give you the same price that a new customer would get coming through the channel that you came through. And so there will be, therefore, some element of inconsistency. So if you came through one comparison site, say Andy, and I came through another, then we might get different renewal prices based upon the circumstances we entered, even if ours were pretty much the same, because our different channels had different pricing. But it's the consistency between the new and existing customer pricing on each channel in their isolation that's important. So there is still going to be some differences out there. And the other thing they've got to do is, if there are monetary incentives provided by an insurance company to new customers, existing customers have also got to have that factored into the prices they get, which is obviously another real positive for consumers who aren't shopping around. Interestingly, it doesn't include non-cash incentives. So, you get the cuddly toys that are sometimes given to people.
I was just about to say, does that mean I get a meerkat every time I renew? But,
Well, what you're going to find probably, Andy, is you're going to get more and more different types of meerkats from different companies, because non-cash things like that aren't included. So those sorts of incentives are going to be probably appearing a little bit more. That's my view anyway, because they're not included. Interestingly, it doesn't include cash incentives from the comparison site. So if a comparison site offers a cash incentive, then that doesn't matter. It's about the insurance company, and if you're a new customer versus existing customer at the insurance company level. So you will still get these cash incentives on the comparison sites that don't have to be replicated to an existing customer, because the cash incentive was done by the comparison site. So you will get some interesting stuff going on there, probably competitively going forward. And the FCA are being pretty tight on the loopholes that could exist, because they've told brands they can't establish sub-brands to increase the prices for existing customers. So you could get this idea where a insurance company could think, do you know what? All the existing customers, we'll just move those off to a new sub-brand down here. So therefore, there is no sort of back history now that's going on with our brands. We just keep moving people around. So the renewal people, the existing customers down there in that new brand, there are no new customers going to that brand, so we can kind of do what we like. That's not going to be allowed. They aren't allowed to be able to do that sort of moving people around. So that'll be interesting to see how that pans out, because they are going to have to watch that quite closely. So what does that mean for consumers? Does it mean they don't have to shop around? Well, the answer is no, it doesn't mean they don't shop around. But the positive is that we are supposed to. I was going to say probably. We are supposed to see prices come down. But what's likely to happen is they'll meet somewhere in the middle. So where you've got new customers currently getting really good deals, existing customers getting bad deals, then everybody's probably going to get something more in the middle part. So if you're somebody who actively shopped around, then you might not think this is necessarily great news for you. You will still get savings, but they might not be as big as before. But this leads me on to why I want to do this as a piece on the podcast, because although I don't tend to do newsy pieces that just go, this is a piece of news at some point in the future, because I only have to then remind people 6 months down the line, it's because that it means that now is a sort of a sweet spot, because we're in a period where the rules aren't in place. So new customers are still able to get better deals than the existing ones until we get to the new year. So if you shop around, even if you're an existing customer not up for renewal, you might be able to get a better deal on your insurance, so your car insurance, your home insurance, and therefore switch to benefit. And it may mean that you have to pay an admin charge if you're in the middle of the contract and you to get out of it. But the saving may be sufficient that will make it worth it. And you should get a prorated refund as well for the amount of the insurance that you haven't yet used. I mean, bear in mind that if it's something like a car insurance policy, that you won't necessarily get the no claims discount for this year because you've not had the policy for the full term, so you will lose out on that. But let's be honest, the saving, you won't particularly care about that in all likelihood. So if you've not shopped around, then do so. If you were due to shop around probably at the beginning of next year, then maybe be worth doing it beforehand, certainly before the end of the year, because you're likely to be able to get a better price. But going forward, we all should be that little bit better off and not have to shop around too much, thanks to that super complaint. And the other little bit of positive news, which goes for all insurers across the board, is that they are going to have to make it easier for us to cancel auto renewals. I spend my life, it feels like, when I get to renewal stages of policies, and I have to say to them, don't put my credit card details on record, don't save them. And then they turn around and say, no, we won't do, and then it won't auto renew. And that means it forces you to shop around when you get to that period of the year, but it also means they don't just suddenly auto renew without you realizing. I know there are communications and that shouldn't really happen, but the reality is we're all very busy, and it makes it far too easy for us to not shop around. So good news for consumers.
Okay, and to finish off the podcast this week, we're going to have one of Damien's famous analogies. You're going to be talking about finances and wealth and how it can sort of be related to a party. I'm all ears.
Yeah, so the review that we read out earlier, where we're talking about people having conversations around the dinner table, and I've end up explaining things to my kids when we talk about topics to do with money and how things work. And I want to try and highlight the realities of money and maybe let them think of it in a slightly different way, because sometimes you think about things in a slightly different way. You may have already grasped a fact, but you just see it in a different light, and it might make you view things slightly differently and take action. And the point is that your money and wealth are like a party, okay? And they're a party that everyone's trying to get an invite to, or gatecrash. That is pretty much what your wealth and money is. And so you've always heard people go, oh, I love a good wedding, or I love a good wedding, and they want to go to one, because the reality is they love a good wedding because it's a free meal and basically a booze up. So they be able to get themselves drunk, and it's not about, let's be honest, it's not about the romance and all that. People like a good wedding, and I can put my hand up and say this: I like a good wedding of somebody I know well, because it means I can have a bit of an all day out, and my friends are there and my wife's there, and it's therefore accepted that we can just sit there and be pretty indulgent on somebody else's money.
And do you know what? It's fantastic for people watching. And if you don't watch at least one or two family or friends fall out over the table as the night goes on, then you've not been to a good wedding, I have to say.
I've seen some amazing weddings. I went to a wedding once where most people probably got a story similar. I didn't know many people at the wedding, and we went to this wedding, and I walked in and we went to the reception, and people were a little bit worse aware. The next minute, it turned into like a barroom like brawl, and there were punches being thrown over the top, and in the end one of them was the father-in-law, and it just got all bundled outside, that like about a third of the men just ended up in a brawl. But what was odd, it was actually a kind of a really upmarket wedding, so it was almost that there was probably, I don't know who the people were, they were family members who got so drunk, and as somebody who was sober at the time, it was one of the best things I'd watched. It was just seeing this wedding descend into complete carnage, and the great thing was it wasn't mine.
There's always a weird disparity between the day guests and the evening guests, because the evening guests turn up sober at the point that the day guests are absolutely hammered, and it's that weird crossover. You definitely fall into one or two of the two camps. Either you're a day guest or an evening guest, and you kind of mix with the people that you know. If you're an evening guester, you definitely mix with the evening guesters. If you're a day guester, then you look at the evening guesters thinking they're not part of the inner circle. And you avoid them on that basis.
Yeah, and the analogy that I want to talk about is that I just think that weddings and parties are a great metaphor for money and the way it works in terms of for people outwardly looking in as well. So if you think about a wedding, the size of a wedding has never dictated the ultimate happiness of the couple. I mean, if you look at it, perhaps I would argue it's the opposite based on some of the people I know. And that is, again, money and happiness, not just talking about weddings, but money and happiness is just, does not ensure the other. And so I think it's a good analogy. I think it provides a good life lesson. But it's more than that. I mean, there's an element to weddings that happens with our own finances, where it's that keeping up with the Joneses. And it's that, again, what I was talking about in podcast 313, about that faking it until you make it. And so you end up inviting lots of people to your wedding, or people expect you to invite people to your wedding, or you try and include things you saw at other people's wedding, like the saxophonist who was really cool, that kind of thing, or the fire breather in the corner, or the bloke doing the magic tricks, the sort of things that you all thought were really good at other weddings, and who should be there, how many people should be there, what the meal's like. And all of these things start to become almost, they take over, and you're doing it for other people's benefit rather than your own. And the irony is, the more people you invite, the more expensive the wedding gets, but the less food and cake you actually get. So that's kind of what happens with money as well. So when you've got your own money, it's like having a party. Depending on how much money you've got, your wealth depends on the size of your party, but it doesn't dictate how good that party is. But what you know is there are going to be gate crashers, wedding crashers, and there are going to be uninvited guests, or those guests you probably didn't really want. And so when we worked in the money world, or when I did in the city, there are people like financial advisors, very good financial advisors, and what they would do is basically scour the publications that are out there, and some of them are very much industry specific, where people might be shown to become a partner in a particular firm. So their affluence, their wealth is just increased. And then they will contact them because they know that basically they've got more money. Fundamentally with the idea of like, look, we're going to help you. We help some of your other partners, all those sorts of things. And I know there's rules around cold calling, but like a party, there's always going to be people who are trying to get an invite to it or who are going to gatecrash it. And your money is exactly the same thing. It works in the same way. There are going to be people who start to be attracted to you and come towards you and to want a piece of that. They want a piece of your birthday cake, your wedding cake, or the enjoyment, but they ultimately don't really care if you're left with none of it at the end, which is what happens at nearly every birthday party or wedding reception. I never had any of my wedding cake. I don't know. I don't think I even ate the buffet, but I was pretty good in terms of the people that I invited. So what you want to do is realize that for a lot of people, you are a meal ticket. So however much money you have, and especially once you start saving and you start accruing wealth as well, you are a free meal ticket to somebody somewhere. And those people will start to come towards you. And so that might be financial advisors who say they're doing the best interest by you or want to give you advice. They're getting paid. They're taking a cut. That could be a platform that you're starting to use. They're taking a cut of the pie as well, your birthday cake. Everybody's going to take a piece of it along the way. And your job is to try and work out who you want to have a piece of that cake or not, and actually have something left for yourself, because the costs soon mount up. And some people don't add anything to the party. They come along and they're detractors. They're the people you see at a wedding who are just standing there drinking the free bar, and people are wondering, who are they? I don't remember inviting them. And they're the people who come along who might be, like to use the analogy, some sort of discretionary wealth manager the financial advisors brought along, or they might be the platform or a fund fee or something you weren't aware that you were paying that effectively is being charged to you all along. They are sucking away from your enjoyment ultimately. And of course, with your wealth, you've got a finite number of people you can invite to this party. So you want to make sure you invite the people that you want. So when you're looking at anything in your finances, whether it's your mortgage, whether it's your bills, all of those are fundamentally like people. You could almost give them emotional names if you wanted to. If it makes you do something about it, they're standing there drinking your free champagne at your wedding. If somebody was doing that and you didn't know who they were, you'd turf them out. And of course, we have that all the time in our own finances. These people who suddenly sort of filter in from the next room, and then they're in there and they're sort of having a free drink. And the people serving the free drinks don't really realise who's supposed to have them and who's not. And that's what happens with your money. You'll get services that you start paying for, whether it's direct debits or anything like that. You weren't too sure what they were. So you've got to make sure that you review everything. Who is drinking at the bar? Who isn't at your party? And be quite brutal about it, because they are ultimately going to detract from any wealth that you have. So give your car insurance company a name, somebody you don't like, you didn't want to invite to your party. If it makes you review it at the end of the year, whether you still want them on the guest list. And I think there's a wonderful irony about weddings, is that a lot of people, the way they are envisaged is that people save up all this money or try and they almost bankrupt themselves producing this wonderful day that really seems to be dictated by other people a lot of the time, what is going to go on. And they're doing all these mistakes, like I said, with hangers on or people they're paying for that they don't really need. And it's almost the complete opposite to what you should really do with money and life. And you're going to get these people who just bleed it all dry. To the end of the day, all you've got, you might have a nice memory, but you don't have really anything else to show for it. So don't be afraid. It's your party to turf people out, is what I'm getting at. And don't be afraid to realise that the people that come along, whether they're services, whether they're actual people like maybe financial advisors or people who've got advice, particularly gatecrashers who are the fraudsters and scammers of this world, they are the equivalent. So you'll have these uninvited people who start turning up, whether it's in your inbox, whether it's by text message. All of these people, be cynical about them. Don't let them in. You don't have to let them. So the size of the party doesn't matter. It isn't about how much money, wealth that you have. That won't ultimately dictate the happiness that you have. But do protect it, do look after it. I remember my wedding, I didn't have a sit-down meal. So I'm always going to be the kind of guy that wasn't going to do things the conventional way, which is probably why I ended up doing this money stuff, really, to be honest with you, because I didn't see the value in it. It was going to cost a fortune. So what I did do is I just got basically everybody drunk on some free booze, which was actually cheaper, and they had much more fun, and I enjoyed it as well. So it's one of those things, you've got to look at the value in everything in life. So don't be afraid to treat your money as your own birthday. It's your celebration. It's what you've achieved. Don't let other people take you for a free lunch.
Absolutely. And just on your wedding, Damien, you might say that was good and everyone enjoyed it. I'm teetotal, so I actually thought it was damn miserable, your wedding. Right. That was very nice.
It doesn't really work for people like you, Andy. Unfortunately, I was playing the room. I was sitting there thinking, what would the majority of the people out there want? And it seemed to be the common denominator was actually alcohol. I'll tell you the funny story of that wedding, and you've probably already heard it. As much as I tried to control what was going on and therefore make it really what the day that we wanted, and I treat like my own finances much in the same way that we want to be able to make sure that it is what we want it to be. I remember going to the bar as the groom and being refused a free drink, and which was still to this day always makes me laugh when the person said, "No, we've run out," and like the person just in front of me at the bar got a drink, and then I didn't, and it was definitely the venue just didn't twig. They were doing the old because I'd said to them, "Look, if we get beyond a certain time, like they've used the bill. If we drink the whole bill, that budget, fine. If it gets to a certain time, then we'll just cap it and then people can pay for their own drinks." And I looked at my watch and it was bang on that time. And I was just like, yeah. And I was like, I made that rule, so we don't have to adhere to it because it was me who made the rule. And in the end, they were real sticklers for it. And I think the guy, I don't know what I just didn't think he knew what was really going on. I don't know. And somebody else bought me a drink at my own wedding, which I know people do buy you a drink at your own wedding, but how many people have been to a wedding where the bar people said you cannot have a free drink anymore because the rule states that by this time we've got to stop serving free booze. Anyway, there you go. That's weddings for you.
Okay, so if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with number 2. We're in all the usual places. Get onto Instagram, YouTube, and don't forget we've got the Facebook group, facebook.com/groups/Money to the Masses, where you can ask questions, put up ideas for the show, and just provide general feedback and love if you like.
So that's it. So until next time.
Until next time.